Alright guys, hi. Welcome to another revision session. This is the third revision session of Mahamarathon which we have started. So are we done with Ind AS 21 already? Yes. Are we done with Ind AS 115? Yes. Now we're gonna go with Ind AS 2. Next, obviously it will be followed by 36. Now, if you want to download the revision material, the PDF of this particular revision or the previous revision videos or the upcoming revision videos, either way, you go to caprasannakumar.com website. There you'll find free downloads column. You can go there and happily you can download. And then after downloading with that material, you can watch this particular revision session and you'll get the best out of it. Trust me, the materials, once you see the session, you'll understand it is the best. Okay. Now, shall we start with the revision session in that case? Obviously, right. Fantastic. So let's move on. All right, Nana. So we're gonna start with Ind AS 2 inventories. Now, many times people feel that this is not that important. Okay. Now, my analysis is tad bit different. So what I feel is it's pretty easy. Okay. 4 to 6 marks. If at all it comes in the examination, it will come for 4 to 6 marks. But there is no mandatoriness in the sense it will not come every single time. Okay. So CA Inter and CMA Inter syllabus is the same to some extent. So thereby you will feel familiar, but at the same time, only problem with respect to this particular Ind AS is that a little bit of costing knowledge is required. Now you do have syllabus of costing in your CA Inter or CMA Inter. If you can recollect that, this will be very easy to understand. Otherwise, it will be a tad bit confusing. Okay, now, just a second. All right. I hope now it's fine. Right. Chalo. So Ind AS to inventories. So what is that we're gonna do in this particular Ind AS? Very simple, three things we're gonna do. First one, measurement of inventories, recognition of inventories, valuation of inventories. These words are very important because we need to write as it is in the exam to get the marks. Keep this in mind. What do you mean by measurement? It is a rule on how to value your inventories, but not the valuation as per. It is a rule. Many a times people get confused between measurement as well as valuation. Therefore, in the revision session, I'm starting with differentiating between these two words. Okay. Measurement means, say for example, we have a rule for finished goods inventory, right? It should be valued at cost or NRV, whichever is less. This rule of cost or NRV, whichever is less, is a measurement rule. Clear? Okay. But I know the rule that cost or NRV, whichever is less, that's how I should measure my inventory. But the next question is how to calculate the cost. You understand the point? How to calculate NRV? How to calculate cost or NRV? That rules are there. Now, cost means this must be included. This must be excluded. NRV means you take the selling price and then you reduce whatever the cost that you incur to sell the good. You got the point? So that how to calculate NRV, how to calculate cost is there. Now that we call it as valuation principle. Got it? So how do you arrive at the measured amount? That computation process is nothing but valuation. The rule, which is nothing but cost or NRV, whichever is less, is nothing but measurement. So first understand this particular difference. Okay. Recognition is nothing but when you can show it in your balance sheet, when you can take it into your financial statements. That also we're going to see. So this particular index talks about these three things, as simple as that, with respect to what? Inventories. Measurement, recognition, valuation. That's all. Chalo, moving on to next one. Let's start with the definition of inventory. Nana, very simple. These are assets, obviously not expenses. We know that. Why? Because what is the definition of the asset? Future economic benefits. Are you expecting any future economic benefits from your inventories? The answer is yes. Yes. So therefore, it is an asset and not expenses. All the logics we will discuss. I mean, we do discuss in the regular class or exam-oriented batch. Since it's a revision session, time is very important. Therefore, I can't go with the logics for everything. I hope you guys can understand. Okay. So they are assets and not expenses. And why? Because they represent future economic benefits, obviously, right? How do you get the benefits out of the inventory? Very simple. If you sell them, you can get the benefit. If it is a finished good inventory, for example, is there any other way of getting benefits out of them? Yes, using them to produce goods or services. If it is a raw material, you got the point. So inventory means it is not finished good. No. There are three types of inventory. It can be finished good, it can be work in progress, it can be raw material. You know what is raw material, you know what is work in progress, you know what is finished good. Okay, right. So if it is finished good, then you can get the future economic benefits from that inventory by selling them, obviously. If it is WIP or raw material, you can use them to produce goods or services that will be eventually be sold. That way also you'll get the benefit out of it. Correct? Right. Pretty simple. Are we done with this? Shall we move on? Okay. Now let's see one by one. Let's try to understand what do you mean by finished goods. Then what do you mean by WIP? Then what do you mean by raw material? First, let's start with finished goods. Okay. Now, the first one is finished goods, Nana. So that's obvious. Finished goods are nothing but goods that are already completed. Once they are completed, obviously they are ready for sale, right? For example, car already manufactured, or FMCG goods which are about to be sold, which are ready, they are finished goods. The second type is WIP. See, when it comes to WIP, it is referred as work in progress. You know this in costing. So where neither it is raw materials nor it is finished good. So obviously they are half completed. We cannot say half. It can be 30%, 40%, 50, 60, 70 completed. The only question here is, even though you can't sell WIP as it is because it's semi-completed, right? However, you can convert that into finished goods, and after that you can sell it and get the benefit. So therefore, still the WIP is considered as an asset. Because are you getting future economic benefit? The answer is yes. Next, this is very interesting. The third one, which is raw material. Now, when it comes to raw material, see, when it comes to finished goods, immediately you can sell it and get the benefit. When it comes to WIP, you can further process it and then make it finished goods and eventually sell it and get the benefit. But what about raw materials? Now, one thing is quite clear, that it cannot be sold as such, which means as raw materials you cannot sell it, because your entire purpose is to convert that into what? Finished goods. Correct? Raw material plus you'll work some labor upon that, and then you'll do some processing. After that, eventually you'll convert that into finished goods. Now, you cannot sell the raw materials as it is. Okay, then what are you going to do with the raw material? You'll be consuming them, you'll be using them. For what? In order to convert that into finished goods. Okay, or sometimes you can also consume certain raw materials in order to give services. So always, there is no rule that always you need to consume your raw materials for the sake of finished goods manufacturing. Sometimes you consume certain kind of raw materials even to provide service as well. Okay, so therefore the point that you guys need to understand is that, does raw material has got any value on their own? The answer is no, right? They have no independent value unless they get converted into finished goods or what? Services. The best example I've got is unprocessed rubber over here. Now, you can come out with the logic saying that somebody has sold you that raw material now, which means it can be sold, but your business is not that. So that's the perspective you have to look into. Got it? Another point, that's the doubt that many students have asked me is that, sir, somebody has sold you the raw materials, obviously you can also sell it outside, so it should have some sort of NRV or something like that, but we use that logic only for valuation of finished goods. Now here, you should not look at it from economics perspective. We are basically doing accounting now, so you look at it from the intention perspective. What is the intention of a manufacturing company? You got the point. Now say for example Hyundai, or some other company. I think I've gave you an example over here. Yeah, MRF. It buys unprocessed rubber. Its intention is to convert that into tires and then sell the tires and through that recover the value. Correct? That is the intention. Does it mean that it can't sell this? It can, but we try to, what can I say, ignore that particular area of logic, right? So it is the intention that you need to look out. So therefore that counters the logic where we say that, sir, we purchased from somebody na, obviously based on that also we can value the raw material. Why are you always saying that we need to value the raw material based on its conversion into finished goods and then eventually it will be sold, which means raw material derives its value from the existence of finished goods. Got the point, right? Anyways, now, so when it comes to measurement of inventories, already we have seen that three types of stock that we have seen, right? One is your raw material, the other one is your WIP and finished goods. We basically categorize them into two. Under one category, you get finished goods or work in progress. Under another category, you get raw materials. Why there is a split? Very simple. Because raw materials derive their value from finished goods because of our intention to convert that into finished goods, because we are a manufacturing concern. Clear? Whereas finished goods have value on their own because you can just sell it, right? Okay. So therefore, let's start with measurement of finished goods or WIP. I already told you the difference between measurement as well as what? Valuation. So let's start with measurement. So what is the measurement rule when it comes to finished goods as per Ind AS 2? It's very simple, cost or NRV, whichever is less. Now how to calculate cost? That is valuation. How to calculate NRV? That is again valuation. Got the point? But how to value your finished goods inventory? Cost or NRV, whichever is less, that is the measurement rule. Got it? Chalo. So finished goods and WIP, the rule is the same. This is very important, Nana. Keep this in mind. Finished goods and WIP, the rule is the same. For raw material, the rule is different. So finished goods and WIP are measured at lower of cost or NRV, whichever is less. Why lower? Obviously conservatism principle, pretty simple. Okay, that I've written over here. Right. Now the next one is measurement of raw materials. Now when it comes to measurement of raw materials, this is a little bit tricky because just now we have seen a sentence that raw material derives its value from finished goods. Therefore, while measuring the raw materials, you think about finished goods first. Okay, what should I think about finished goods? Very simple. You manufacture finished goods now, right? Or you're about to convert this raw material and manufacture that into finished goods in future. In future, okay. Now you see whether you'll be able to sell that finished goods up and above the total cost that you've incurred so far. Got it? You try to see what's going to happen in future. Are you going to sell the finished goods up and above the cost? Sir, yes, sir. If that is the possibility, where finished goods are expected to be sold at and above cost, in that case, you measure your raw materials at cost itself. Okay. Which means what, sir? Can you give me an example? Yes. See here. Say, for example, the raw material is tire nana. You have purchased the raw material at 40,000. Okay. And some other cost and all you have incurred like labor and overheads, that, this, vagara, everything put together, inclusive of raw material, the total cost is 4 lakhs. Okay. Now this is the total cost. Now what is the question you need to ask yourself? Finished goods you'll be able to sell up and above cost. Let's say I'm able to sell it at 4,20,000, which means I'm recovering the entire finished goods cost. Yes. In that case, you can value your raw material based on cost itself. What is the cost, the purchase price which I've incurred? How much is that? 40,000. Of course, inclusive of certain taxes and all that. That we'll see later. So therefore, the raw material will be valued at 40,000. How did I get this 40,000? Based on my thought process whether finished goods can be sold up and above its cost. Now, say for example, let's say raw material value is 40,000. You can convert that into finished good. Let's say finished good can be a bike. And the total cost of manufacturing is 4 lakhs, which we have already discussed. But unlike the earlier case, you can't sell it for 4 lakh 20. You can sell it only for 3 lakh 80. Now, what is the situation? Very simple. Are you able to recover your cost? No, sir. Which means loss situation, which is case 2. In that case, are you going to value your raw material at cost? Is the price at which you have purchased the raw material, which is 40,000? The answer is no. Immediately check for replacement cost. So what is meant by replacement cost? It is not the cost at which you have purchased your raw material already. It is the cost what if you can do. I mean, in a way, if you purchase the raw material today, then what is the cost? So the simple logic is the replacement cost is nothing but if you buy today, then at what price can you get the so-called raw material? Okay, say for example, it is 35,000. Then naturally, what will be your thought process? So 40,000 or 35,000, whichever is less. So whichever is less means you'll be going with 35,000 as the valuation of your raw material. Suppose replacement cost can be otherwise as well, right? It can be greater than your cost of purchase of the raw material. Today, the raw material price should have got increased. So if it is 45,000, then again whichever is less. So in that case, it will be measured at cost itself. So even though these two situations may seem similar, because here also it is 40,000, here also it is 40,000, it all depends upon the replacement cost. So the final summary is very simple. If you want to value your raw material, okay, inventory, simply see what's going to be the situation of the fixed cost. If you can recover more than the fixed cost, then value your raw material at cost. As simple as that, no confusion. If you can't recover the fixed cost, then check the raw material cost with today's replacement cost of the raw material. Whichever is low will be your answer. It can be raw material cost as well, or it can be replacement cost as well. Got it? That is the summary. Are we done with this? Chalo, next. Another thing is when it comes to finished goods and inventory, I told you that measurement of finished goods will be cost or NRV, whichever is less, correct? But here many people, they confuse NRV with FELCTS, fair value less cost to sell. Now both are different. In what way they are different? For example, fair value less cost to sell means you can just go to the market, you can present your so-called finished goods, and you can see at what price can you sell minus whatever the cost that you incurred to sell it. Got it? That is fair value. So it's not entity specific. It's general fair value, general price at which you can sell in the market. But NRV means it is entity specific. Entity specific means it is customized for your company. It is a customized order for your company, which can be greater than market price as well sometimes. For example, see here. An entity holds 500 units of inventory. Okay. Market selling price is 20 per unit, which means that is the fair value, right? So fair value is 20. However, entity has an order in hand which is specific to the entity. All the entities does not have this. Got it? Where you are able to sell it at 22 per unit and the order is confirmed. And for that, let's say incremental selling cost is 1 rupee. In that case, the NRV is 21, not 20. So many times we feel that fair value is nothing but NRV. The answer is no. So as a company, as an entity, for me, there is a specific customized order of 22 per unit. I can sell it at 22 per unit. Are you able to understand? Whereas the general selling price, the general market price is 20 per unit, which is nothing but fair value. But however, for me, entity specific, there is an order where I can sell it for 22, and for that the selling cost is 1 rupee. So therefore, NRV is quite different from fair value. Got it? Alright guys, so let's continue with the revision. So now this is what we have seen. We have learned the difference between NRV as well as FELCTS, right? Sometimes FELCTS is also called as fair value less CD, cost of disposal. Cost to sell, sometimes it is also referred as cost of disposal. So keep that in mind just in case. Okay, FELCTS or FELCD both are same, cost to sell or cost of disposal, right? Okay, now to understand this better, already we have gone through this particular example, tire example. I'll give you one more example because many people, they get confused between valuation of raw materials as well as what? Finished goods. For finished goods, it is cost or NRV, whichever is less. For raw materials, things are totally different. While to value the raw materials, first you need to think about what's going to happen to the finished goods. Are you going to recover the cost of finished goods? So I'll compare both with an example. After that, we'll solve a problem as well in this revision session itself, okay? So that you'll understand better. See here. Valuation of raw material as well as finished good. Mostly WIP will not come in this particular Ind AS, Nana, so forget about that. So on one side I've got raw material, on another side I've got what? Finished goods. Finished goods is very easy. Say for example, total cost is 10,000. Okay. What is the valuation? Cost or NRV, whichever is less. Okay. Your cost is 10,000. Let's say NRV is 12,000. That will be given in the question. So 12,000 or 10,000, whichever is less. So your value will be 10,000. That's all. Okay. Now, in this case, cost is 10,000. Suppose NRV is 8,000, whichever is less. In that case, the value will be what? 8,000. Because the value is 8,000 now, your actual cost was 10,000. Therefore, you need to write down the value by 2,000. And there is a loss of 2,000. But in this case, there is no write down of value. Why? Because your NRV is greater than the cost. So, you'll keep it at cost itself. So, cost or NRV, whichever is less. 10,000 or 12,000, 10,000, 10,000 or 8,000, 8,000. Thereby, you need to reduce the value by 2,000. Got it? This is very easy. Raw material is one area where it's a little bit complicated, little bit only. Why? Because while valuing raw material, you need to think about what will happen to the finished goods in future. Okay. Let's say the cost of the raw material is 300. Okay. Which means when you bought the raw material, the price at which you bought it already, at that time, you paid 300 to buy the raw material. But now if you want to buy this raw material again today, then the cost is only 280. You can get it for 280. That is nothing but what we call it as replacement cost. I would have purchased 1 month back or few weeks back or few days back as well. When I purchased at that time, the price was 300 and that's how the cost is recorded. Correct? Whereas today, if I want to buy the same raw material, it can be available at 280 itself, which we call it as replacement cost. Okay, sir. Now, to find the value of raw material, now straight away you cannot say, sir, cost is 300, sir. Today it is available at 280 in the market, sir. Thereby we'll write down the value of raw material by 200, sir. Sorry, 20 now. We'll write down the value of raw material by 20. Like that, you should not decide straight away. Wrong. To write down the value of raw material, first you need to think from finished goods point of view. What is that, sir? How much is your finished good total cost, sir? 1,000, sir. Which means upon this raw material plus labor plus overheads and all the costs put together, total cost is 1,000. Are you able to recover that 1,000 when you sell the finished good? Yes, sir. I'm able to sell the finished good for 1,300, which means, are you able to recover this entire 1,000? Yes, sir. In that case, no need to write down the value of your raw material, even though the replacement cost is less. Even though today raw material is available at lesser price in the market, even though you keep it at 300 itself. So raw material cost will be at 300 itself. Very important. So many times we tend to get confused thinking that, no, sir, today the raw material cost is 280. When I purchased it was 300. So price has got fallen. Therefore, I'll reduce the price. No, you need to wait, think from finished goods perspective. Then only you should reduce the price. In this case, you are able to recover because in this total cost, this 300 is there, na. And you are able to recover that 300 through the selling price. In that case, why should you reduce the value of the raw material? That is the logic. Clear? Okay, sir. Let's go to scenario 2. Same cost 300, same replacement cost 280. Total cost is 1400. Say for example, and your finished good selling price is 1300. Are you able to recover the total cost? No, sir. You are not able to recover your total cost, na? Yes, sir. Then the The rule is cost or replacement cost, whichever is less. The replacement cost is lesser, which is 280. Then you reduce the value. Which means if you are not able to recover the total cost of your finished good, this is the first condition that you need to satisfy. Then you think about cost or an replacement cost, whichever is less. And in this case, because replacement cost is less, therefore you'll be valuing your raw metal at 280, which means you'll write down the value of the raw metal by 20 rupees. But look at scenario 3. This is very interesting. Are you able to recover your cost here? Cost of finished goods? No, sir. My total cost of finished goods is 1400 and I'm able to sell it for 1300 itself. Are you able to recover the cost? No. When you're not able to recover the cost, what is the condition? Cost of the raw material or replacement cost, whichever is less. But in this case, replacement cost is more than the cost. Then the value of your raw material will be cost itself, which is 300, which means in this case also there is no write down. In this case also there is no write down. In this case only there is write down. So which means write down of raw material will happen if two conditions are satisfied cumulatively, not just one condition. What are those two conditions? One, you are not able to recover your total cost. You are not able to recover that. Two, your replacement cost should be less than your normal purchase cost of the raw material. The price at which you have purchased, okay, when compared to that, today's price should be less. Replacement cost is nothing but today's price, na? Cost of raw material is nothing but, let's say, yesterday's price. So today's price should be less than yesterday's price. That is one condition. And also you should not be able to recover your total cost of finished goods by selling, which means your selling price should be less than the total cost. If both the conditions are satisfied, only then write down of the cost will happen of the raw material. For example, 300 is the value right now. You'll be showing it at 280, which means you'll write down the value by 20. If only one condition is satisfied, for example, total cost is getting recovered. Here total cost is getting recovered, which means you will not write down the value. For example, replacement cost is less than cost of raw material. This is getting satisfied and total cost condition is not getting satisfied. So which means in that case also you will not write down the value. So what you need to understand is that when both the conditions are satisfied, then only you will write down the value. That is the point. Are we done with this? I think this example should make it very clear. Chalo. Now let's go and solve a problem fatafat. Look at this sum. You have opening inventory, finished goods, 1000 kgs, 25,000. Raw material, 1100 kgs, 11,000. And then you have got total 10,000 purchase here, which is 1 lakh. Labor is also given. Overheads fixed is given. Sales, 10,000, 2,80,000. Closing inventory, raw material and finished goods. In kgs it is given. Value is not given. That's what we need to find. We need to find this value. Closing value of raw material, closing value of finished goods. That's what we have done here now. We have learned the concept. Valuation of raw material, valuation of finished goods. Valuation of raw material, valuation of finished goods. That's what we need to find. The expected production for the year was 15,000 kgs of the finished good. Due to fall in market demand, the sales price for the finished goods was 20 per kg. And the replacement cost for the raw material was 9.50 per kg on the closing day. Calculate the closing inventory on that particular date. Calculate the closing inventory means that value. Done with this, Nana? Okay. Now, one thing is quite clear. To solve this sum, ultimately, we need to find out closing value of raw material inventory as well as finished goods inventory. That we know how to calculate. But one more concept we need to learn to solve this particular problem, that is how to calculate cost of inventory. Sir, what is that, sir? That is what we are going to learn right now. Cost of inventory calculation. After that, we'll be solving one more sum as well, okay? As part and parcel of this revision set. Now, you guys stay with me. After that, we'll be solving back-to-back two sums. No. Ultimately, when it comes to calculation of cost of inventory, indirectly, I'm talking about finished goods only here. What kind of inventory I'm talking about? Finished goods. So to value that finished good, the total cost of per unit of finished good is divided into 3. What am I talking about? Total cost per unit of finished good is divided into 3. First one is cost of purchase. Second one is cost of conversion. Third one is any other cost that you have incurred, just like PPE, to bring the so-called inventory to the present location and condition. Got it? First two are important. This is not that important. Okay, cost of purchase, cost of conversion. So what is cost of conversion? Very simple. Labor cost plus overheads. Labor cost plus overheads. Because conversion cost means first you'll have raw material that will be converted into finished goods. In order to do this conversion, what are all the costs that you're going to incur other than raw material? Other than raw material, what you have got? Labor and overheads. That's all simple. So labor plus overheads is nothing but cost of conversion. Clear? So cost of purchase, cost of conversion, any other cost that you incurred in order to bring the raw material to the condition and the location. Got it? Okay. So ultimately, that's how you calculate total cost per unit of finished goods. If you look at this question also, well, in order to calculate total cost of finished goods in this particular question, first we'll go for raw material consumption, right? Then we'll go for labor, then we'll go for overheads. You add all the three, you'll be getting your total cost per unit. But to solve this sum, we need to learn further concepts as well. Chalo. This one is clear? Right. Now let's move on. First, we'll see how to calculate cost of purchase. Then we'll go for cost of conversion. Then finally, we'll be looking at other cost incurred in bringing the inventory to their present location and condition. Clear? Okay. Now, cost of purchase. Now, depending upon what kind of company you're running, you will understand that the cost of purchase will vary. Will vary means what, sir? For example, if you are a manufacturing company, then when I'm talking about cost of purchase, you will purchase what? If you're a manufacturing company, I'll purchase raw material. Therefore, indirectly, I'm talking about raw material cost. But if yours is a trading company or retail company, trading company is not the correct term. Let's use the term retail company. Like DMart. In that case also you'll be purchasing, na? But there you're not purchasing raw material, na? You're purchasing finished goods and then reselling them. So therefore, when I'm talking about cost of purchase, whether I'm talking about raw materials or finished goods, it depends upon what kind of company you're running. Clear? Okay. No matter what, let's try to look at how to calculate cost of purchase. Very easy. Purchase price net of trade discount as well as rebates. Okay, sir. Add all the non-refundable taxes. Refundable taxes means it will not be added. Non-refundable will be added. And then transport, freight and handling charges also will be added. Everybody knows. Any other expenditure which is directly attributable. Directly attributable means directly related to purchase of inventory. That is purchase of raw material in this case. Got it? Directly attributable means, for example, insurance, some brokerage. All this put together, we call it as cost of purchase. So very easy. The moment you see the question, you'll understand this will come. Okay. Now tell me, if I need to ask you how to calculate cost of purchase, what will be your answer, sir? What is this, sir? First, purchase price, whatever that you actually pay to the vendor, less any trade discounts or rebates. Okay. Then what are the other things? The non-refundable taxes. Very good. Then freight, handling charges. Okay. Anything else? Directly attributable expenses means, like for example, freight insurance, brokerage charges, etc., etc. You total it up. That's it. You're done with cost of purchase. Okay. What is the next one, sir? Cost of conversion. What about cost of conversion? Very easy. Raw material will be converted into finished goods. So whatever the cost that you incur for conversion, we call it as cost of conversion, which includes labor as well as overheads. Labor as well as overheads. That labor is referred as direct cost, and overheads is referred as indirect cost. Got the point? And when it comes to overheads, which is nothing but indirect cost, you have got two types of overheads, fixed and variable. Got it? In case of labor, you need not learn anything. It will be given in the question. You just copy paste. Because this is not costing, na. So that many complications will not be there. For example, you see this question. Do you need to learn anything to take labor here? 76,500 is given. Just copy paste that. That's all. So therefore, nothing much to learn. Whatever that is actually given in the question, copy paste that. With respect to indirect cost, that is overheads. Here we have a problem. Because the so-called overheads or indirect cost is divided into fixed as well as variable. Again, in case of variable, it's very easy. In case of variable overheads, where is it? Yeah. In case of variable production overheads, it's very easy. Whatever that is incurred in the question, the actuals that you'll take. For example, look at this question. What is a variable production overheads over here? I think it is not given. Entire overheads is fixed only. This question, it's not there. But generally what happens is that if there is variable production overheads, it will be given in the question. Directly you take it per unit basis, multiply with number of units, you'll get the answer. That's why I've written here, always charged at actuals. Whatever that is given in the question, copy paste, just like labor. So there are no complications, which means when it comes to cost of conversion, you have labor, then you have overheads. In overheads, you have got fixed as well as variable. So labor, copy paste from the question. Variable overheads, copy paste from the question. Fixed overheads only will trouble you. So therefore, our focus is to learn fixed overheads. Clear? Okay, sir. Fixed production overheads, how to take while valuing the inventory. That is what we are going to learn. Okay. For that, let's take this example. Okay, so that you'll understand it without any confusion. Ready, yeah? Everybody? All right, Anna. Now, so look at this example. Let's say total fixed overheads is 9 lakhs. When I say overheads, I'm pretty much talking about the factory overheads right now. Okay. Normal production is, say, for example, 50,000 units. You can also call it as expected production. This normal production, in some questions, you'll use the word expected. So whether it is expected or normal, it's nothing but the same. Okay. Your actual production can be less than normal production, can be equals to normal production, or can be greater than normal production as well. Sir, how is that possible, sir? You'll work overtime, Nana, as simple as that. Okay. Now, Okay. Now let's say if your actual production, which is 40,000, is less than normal production, which is 50,000. In this scenario, let us see how we'll calculate fixed overheads cost per unit. Very simple. 9 lakhs is the fixed overheads, right? Put it in the numerator. In denominator, either you can take 50,000 or you can take 40,000. Either 50, which is normal production, or 40, which is actual production. Well, what Ind AS 2 says is that you take whichever is higher. Whichever is higher means 50,000 or 40,000. Which is higher? Sir, 50,000 is higher. Then you take 50,000. Then your fixed overhead cost per unit will be 18 per unit. Now you might be interested to know why it is whichever is higher. Again, conservatism logic only. When the denominator is higher, automatically the resultant number will be lower, na? So that you will be absorbing less. It's as simple as that, right? Look at this particular scenario. If your actual production is greater than normal production, then what's going to happen in this case? If your actual production is greater than normal production, what's going to happen in this particular case? Whichever is higher, exactly. Whichever is higher means you will be going for actual production, which is how much? 15 per unit. So basically what you need to understand is that if you need to calculate fixed overheads while calculating cost of inventory, first you need to calculate overhead recovery rate or overhead absorption rate. That is nothing but this one. Sorry, this one or this one. Now to calculate overhead recovery rate or overhead absorption rate, you take the overheads in the numerator and divide it with unit. Now when it comes to units, you have two choices. Either you can go for normal production or you can go for actual production. Ind AS 2 says go for whichever is higher to find overhead recovery rate or per unit. So whichever is higher in this cases, accordingly I went for that. So that ultimately my fixed overheads cost per unit will be less. Okay. Now in this case it is 18 per unit now. Okay. You have calculated recovery rate. Then what you have to do, absorb the overheads or recover the overheads. How to recover? Very simple. Multiply with actual output. So 18 per unit into actual output or actual production is 40,000. 18 per unit into 40,000 is how much? 7,20,000. That much you will observe. Sir, but my total fixed overheads is 9 lakh na sir. I have observed only 7,20,000 na sir. Yes. The balance 1,20,000 is unobserved fixed overheads. What I should do with that, sir? Transfer it to P&L account. Charge it to P&L. Okay, sir. Sir, what about this scenario? Here actual production is higher. Therefore, in the denominator, you have taken whichever is higher. When compared to normal production, your actual production is higher. Therefore, I have got 15 per unit. Correct? Now, what should I do? Very simple. This 15 per unit should be multiplied with actual output. What is your actual output? 60. So, in that case, exactly what you have observed and what is actual fixed overheads, both will tally in this situation. You got the point? But logically speaking, just use your common sense. Out of these two situations, where the probability is high, this side the probability is high. Normally, your actual production generally will be less than what? Normal production. Your actual production being more than normal production is pretty rare. So therefore, this situation you will not face while solving sums. This is the situation that you will face mostly 90 to 95% of the questions. Therefore, whichever is higher means normal production will be higher. You will be getting a particular overhead recovery rate. You multiply that with actual output. Then you will be getting unabsorbed overheads that will be taken to what? P&L account. Simple. That's all. Clear? Everybody? Right. Okay, fantastic. So which means we are done with all these three when it comes to cost of inventory calculation. Cost of purchase we know. Cost of conversion also we know. Labor, copy paste from the question. Variable overheads, copy paste from the question. Fixed overheads, just now we have seen how to calculate. And finally, other cost incurred in bringing the inventory to their present location and condition, that will be given in the question. Accordingly, we'll solve it. So that is not that important. Clear? All right. Now what we need to do is that let's start doing sums. We already started with one problem, Nanana. That problem is 16. Okay. After that, we'll go for 26. Okay. Let's start solving 16. This already we have read the question. So now that we know how to calculate fixed overhead recovery rate or fixed overheads per unit, so thereby now we can start understanding this particular question. So what we need to calculate ultimately, value of raw material closing stock as well as value of finished goods closing stock. Here. If you can look at the calculation, the first step I need to calculate is cost per unit of finished good. Now, why this is my first step? Well, the answer is very simple, because whether you are going to value the finished goods, which is cost or NRV, whichever is less, or you are going to value the raw materials, in both the cases, they are dependent on finished goods only. In raw material valuation also, I need to think about what is the total cost of finished goods and whether the selling price is greater than the total cost of finished goods. I need to think in those terms. So therefore, whether I'm going to value the raw material or I'm going to value the finished good. In both the cases, I need finished good cost per unit, total cost per unit of finished good. Clear? And that is the reason my first step is to calculate total cost per unit of finished good. How to calculate that? Very easy. Raw material, labor, overheads, which we already know. Raw material is what? Raw material consumed only, na? Because once you consume raw material, then only they get converted into finished goods, na? Naturally. So how to calculate raw material consumed? Opening stock plus purchases minus closing stock. That is there in the question. Copy paste these numbers. You got raw material consumed as 10,200 into raw material purchase cost per unit. That is also given in the question. If you can see here, 1 lakh is the total cost. 10,000 kgs you have purchased, which means per kg it is 10. Just a sec. You multiply with that, you get your raw material consumption. Labor, copy paste, 76,500. Overheads, totally it is fixed. There is no variable overheads. Therefore, we need to calculate fixed overhead cost. Correct? Now, how to calculate fixed overhead cost? For that, we'll go for working note. First, we need to calculate absorption rate or recovery rate. How to do that? Total fixed overheads in the numerator. In the denominator, what I should take? Normal production or actual production, whichever is higher. Now, first of all, normal production is given in the question, which is 15,000 kgs. You can see it over here. Expected production for the year is 15,000 kgs of finished good. I told you, expected is nothing but normal. Then what about actual? Actual is not given. All you have is, as you can see here, you got the opening stock of finished goods. Yes. You got the sales. Yes, 10,000. And you have got closing finished goods. So you have opening finished goods, you have sales, which is 10,000. You have closing, which is 1,200. So sales plus closing stock minus opening stock will give you production, actual production. Sorry. That's what I've done here. Sales plus closing stock minus opening stock. You got your actual output. Now, normal or actual, whichever is higher. What is higher? Normal is higher, 15,000. Therefore, take fixed overheads, divide it with normal, which is 15,000. So fixed overheads is 75,000. From the question I've copy pasted, divided by 15,000, you get 5 per kg. Got the point? Now, this 5 per kg into how many kgs you have consumed? 10,200 kgs, na? That's your actual output, right? So 10,200 into 5 per kg. Because I told you, once you calculate overhead recovery rate or absorption rate, you need to multiply that with actual output. Actual output is 10,200. Therefore, 5 into 10,200. How much you have got? 51,000. That's all. You total it up, you get your total cost. You divide it with number of kgs of actual output, which is 10,200, which just now we have calculated. You get total cost per kg or total cost per unit of finished good. Now, once I know this, now I can start valuing raw material inventory as well as finished goods inventory. First, we'll start with finished goods inventory because it is easy. Cost or NRV, whichever is less. What is cost? Just now we have calculated, na, 22.5. That is your cost. What is NRV? It is given in the question. 20 per kg, right? So cost or NRV, whichever is less. So obviously, what's going to be your answer? 20, because 22.5 or 20, whichever is less, it is 20, right? How many units of finished goods stock you have got? 1200 units, which is given in the question again. You can see the question over here. 1200 is the closing stock of finished goods. So naturally, 1200 into 20, that's all. 24,000, simple. Got the point? Right. Now, what about raw material? Now, this is interesting. First, you need to take the cost. What is the cost of raw material? 10, which we already know here, correct? Then replacement cost is given in the question, which is 9.5, correct? You keep it like this. First, keep it like this. Now, look at the selling price of your finished good, which is 20. What is the cost per unit of finished good, which we have calculated, which is 22.5. Are you able to recover the total cost per unit of finished good? No. If you are not able to recover the total cost per unit of finished good, then cost of the raw material or replacement cost, whichever is lower. Cost of raw material is 10, replacement cost is 9.5. Therefore, the valuation of raw material inventory will be 9.5. Therefore, 9.5 into how many units of raw material you have got? 900. That's all. 900 into 9.5, which is 8,550. That's it. Valuation of finished goods is done. Valuation of raw material in also done, which is closing inventory, obviously. Chala, done. Okay. 26th question is done. Sorry. In the question, what we have done, right? Let's go to 26 as well. One more question. Chala. Okay. Now look at this. This question tells you how to calculate cost of inventory. Already we have seen how to calculate cost of inventory means it is divided into three parts. One is cost of purchase. correct? Other one is cost of conversion. And third one, I told you it is not that important. Whatever the cost that you incur in order to bring the raw material into the location and condition as the case may be. That is the third one that we have seen. Okay, these two are important. Cost of purchase, cost of conversion. What is cost of purchase? Can you please tell me? Sir, what is there, sir? Purchase price, whatever that you pay to the vendor, minus any rebates or trade discounts. Okay, then what you need to add for that? Non-refundable taxes. Okay, anything else? Freight and holding, handling costs, sorry. Okay, anything else? All the directly attributable costs, like for example, insurance, brokerage and all that. That's all. Cost of conversion, sir, cost of conversion, just now we have seen labor plus overheads. Labor, copy paste, direct labor. Overheads means fixed as well as variable. That's all. We can add all these things. It is nothing but cost of inventory calculation. This question is based on that only. So while reading the question only, we'll try to understand and then we'll go. A Limited began operations in the year X1, X2. In X1, X2, it incurred the following expenditure on purchasing the raw material for its product. All you have to do is find out the cost of inventory in the books of A Limited, as well as you need to pass journal entries. So let's try to find the cost of inventory. First, cost of inventory is divided into three parts. First one, cost of purchase. Cost of purchase means purchase price of raw materials. Will I take? Yes, 30,000 will be taken. I think here is the working note. 30,000 is taken. Okay. Then what else? Non-refundable taxes. Will I add this? Yes. Refundable taxes? No. Freight cost? Yes. Unloading the raw materials? Yes. Packaging cost? Yes. So 30,000 plus 8,000 plus 3,000 plus 20 plus 2,000 minus rebate, which is 530. That's what you have got here. Their answer of cost of purchase will be 42,490. Very easy. Okay. What is the next one? Conversion cost. Conversion cost means what? Labor plus overheads. What is labor? Salary of machine workers in the factory. Machine workers. So it is labor. Labor is how much? 5,000. So that you need to consider. Next, overheads. Overheads means two types: fixed, variable. Salary of the factory supervisor. Fixed overheads only, na? This is because salary is fixed. 3,000. Fixed production overheads. Depreciation of the factory building and equipment used for production process. That is again inside the factory. Fixed production overheads. Consumables used in the production process. Consumables will vary. Therefore, it is variable production overheads. All this you need to consider as cost of conversion. Depreciation, fixed production overhead. Factory electricity usage, fixed production overhead. Factory rental, fixed production overhead. Depreciation of the entity's vehicle used by the factory supervisor, fixed production overhead. Okay. Then what about administrative expenses? When it comes to administrative expenses, while calculating the cost of inventory, you should not take it in full. If you can see the question, of the administrative expenses, 20% is attributable to administering the factory, which means out of all these expenses, you should take only 20%. 500 into 20%, 150 into 20%, 3050 into 20%. And what about the selling expenses? Selling expenses are irrelevant because selling expenses are incurred to sell the finished goods, not in making the finished goods, not in manufacturing the finished goods. Therefore, selling expenses will be ignored. There ends the matter. That's all you have to see. This we have already seen. Direct labor, all the fixed production overhead, copy paste, copy paste, copy paste. With respect to administration, it is 20%, 20%, 20%. And variable production overhead is nothing but consumables. Total cost of conversion is there. Easy. That's all. Based on this, you need to pass the entry. That's all. Now, in entry, what you will do? All this will basically increase the cost of your inventory. Whenever your inventory cost is getting increased, it is an asset. Therefore, you need to debit inventory account debit 2. How are you getting it increased? If you are paying this as a cash, which one? Cost of purchase, then 2 bank or cash, otherwise 2 credit, right? Other thing is when it comes to these expenses, whichever you are paying in cash, 2 cash or bank. But with respect to depreciation, that is not something that you pay in cash. The depreciation, what will be an entry? 2 PPE, because depreciation will eventually reduce the value of PPE. Wherever you get depreciation, there you will write 2 PPE. That's all. There ends the matter. That will be your entry. See the entry. First one, inventory to cash on bank for this cost of purchase, because here we did not take credit. It means that we have paid in cash. Then again, you will debit inventory because ultimately all these things will increase the value of inventory only. Na. When you're adding, it means you're increasing the value of inventory. Therefore, it is an asset. Therefore, it has to be debited. And if you pay it in cash, it is 2 cash or bank. If it is depreciation, 2 PPE, 2 PPE, 2 PPE. Whenever you get depreciation, it will be 2 PPE. Simple. Because depreciation 2 PPE will be the entry. Na? Simple. Got it? This consumable stores entry, you need to keep it in mind. It is inventory account debit to inventory. Because 2 types of inventory. One is an inventory, which is a kind of finished goods where it is becoming an asset. To that extent, you should debit the inventory and thereby finished goods value will increase. And that will be shown in the balance sheet eventually if it is not sold. Correct? Whereas at the same time, consumables, if you have consumed, means that inventory will get reduced. Na? Therefore, to inventory, within brackets, you need to show the difference by writing consumable stores. That's all. Simple. Are we done with this? Right. Fantastic. Let's move on. Okay, this problem is also done. Next, there are some special note points. Fatafat, we'll see this. Now, if you look at this, Nana, it's a pretty routine point. Inventory acquired on deferred settlement terms. Okay, it's pretty simple, Nana. Whatever the inventory value that you take, you should take it at a cash price. Got it? If normal credit period is, say, for example, 20 days or 30 days, then that's fine. But for you, if special credit period is given, like for example, 2 months or 3 months or 4 months, then naturally because of that, the price will be more. And that extra price is like finance cost. It is like interest cost. It is not the cost of the inventory. So therefore, you have to split it, and you can't overvalue your inventory. That is the logic. Extra amount paid over the normal purchase price, that is cash price, is recognized as interest expense over the credit period and not included in the cost of inventory. It's pretty simple. So that we need to ensure that inventory is not overstated. Simple point. Next. Another case scenario is if there is joint products and byproducts. In this scenario, what you will do? Let's try to understand this. Now, Nana, please try to understand. Sometimes what happens is that there is a process. Okay. At one particular point, all of a sudden, you'll start getting multiple finished goods out of that process. Got it? Because multiple finished goods are coming at a time in a joint way, we call them as joint products. And this process is called as joint process because it gave rise to joint products. And the cost that you have incurred till that particular point of time to give rise to these joint products, we call it as joint cost. As per your Ind AS 2, this joint cost is also referred as cost of conversion. Yeah? Okay, right. Now, okay, what you will do with this three? Okay, the point at which a single process all of a sudden splits into three joint products. This particular point, we call it as split off point or separation point. These are all the basics that you should know. Okay. Now, what is that we are trying to learn here? Very simple. This joint cost, let's say it is 1 lakh. This 1 lakh, you have incurred it together for product A, B, and C. How are you going to apportion? That is what we are going to learn, because we need to value the inventory of these joint products. Normal inventory means its valuation is very easy. Here you need to value because a single joint cost is incurred for all the three joint products. Therefore, how to value the inventory? For that, what Ind AS 2 says is that very simple. Find out their sale value. In the ratio of sale value, you apportion the joint cost. That's all. As simple as. Okay, fine. So I'll just find out the ratio of the sale value of A, B, and C. In that ratio, I'll try to apportion the joint cost between A, B, and C. Then automatically, I'll know the value of the inventory of A, value of inventory of B, value of inventory of C. Then one more doubt comes. What if there is a byproduct? So what is byproduct basically? I incur all this cost with an intention in my mind to get A, B, and C. I don't have any intention to get Z. But all of a sudden, incidentally, Z also comes into picture. And if you look at the value of the Z, it is relatively much lower when compared to the value of the joint products. That is the proof that Z is a byproduct. Now, what you will do with the byproduct? Very simple. In itself, it does not have any value because you are getting it at free of cost. Now, you don't have any intention to get the byproduct. Your intention is to get A, B, C. But Z, just like that, it comes. Therefore, what is the cost of getting Z? 0. But Z has got some value in the market. So find out the value. Sometimes Z can be sold immediately after split off point. Sometimes Z cannot be sold immediately. You need to further process and then sell. Then what you will do? Very simple. After further processing, if you sell the byproduct, what is the sales revenue? You take that and then you reduce the further processing cost. Then there is a net amount that you will be getting because of the byproduct. Now that you reduce it from the joint cost. That is the trick. And the net joint cost will be apportioned to joint products in the ratio of their sale value. Got the point? So the final summary of joint and byproducts concept with respect to Ind AS 2 is very simple. Find out the sale value of the byproduct. If the byproduct is further processed, reduce that. You'll get the net sale value, net realizable value. That you reduce it from the joint cost. You'll get net joint cost. And this net joint cost, you apportion it to A, B, and C, or any joint products for that matter, in the ratio of sale value. That's all. Okay. To understand that, you can just look at this particular example. Let's say total cost is raw material plus labor plus overheads put together. It is 6 lakhs. Okay. You have two joint products over here. One is 2000 units, the other one is 1000 units. Selling price is 10 and 15. Sale value of the units produced 20,000 as well as 15,000. In this ratio, you need to apportion this joint cost. The ratio of 4:3, you'll get your joint cost per unit. That's all. Joint cost per unit means what is cost per unit for one joint product, which is A, as well as B. Got the point? Okay, to understand this better, we'll also solve the sum, question number 8. Let's go to question number 8. Understand joint and byproduct concept. Okay. Okay, look at this question. It has come for 5 marks. In a manufacturing process of Mars Limited, one byproduct BP emerges besides two main products MP1 and MP2 apart from scrap. Details of cost of production process are here under. You've got raw material, units and amount is given, wages is given, fixed overhead, variable overhead. Two joint products MP1 and MP2 output is given and closing stock is also given. BP is the byproduct. Average market price of MP1 and MP2 with the joint products, which are joint products, is 60 and 50 per unit respectively. Byproduct will be less. It is sold at 20 per unit. There is a profit of 5,000 on the sale of byproduct after incurring separate processing charges of 8,000 and packing charges of 2,000. 5,000 was realized from the sale of scrap. Okay. Calculate the value of closing stock of MP1 and MP2 as on 31st March 20x1. That is the question. Now, okay, Nana. Now, how to solve this? Very easy, Nana. All you have to do is, what is the steps that I've told you? First, find out joint cost. Then you reduce the scrap value from byproduct. You'll be getting net joint cost. You take that net joint cost, apportion that in the ratio of what? Sale value of joint products. Automatically, you'll be getting the valuation of joint product inventory. That's all. So first, we need to calculate joint cost. How to calculate joint cost? Raw material plus wages plus fixed overhead plus variable overhead. That's all. Look at the solution over here. Raw material plus wages plus fixed overhead plus variable overhead. Copy paste from the question. 1 lakh 50, 90, 65, 50. That's all. You add all those things, get your total cost. From this, we need to reduce NRV of the byproduct. What is NRV of the byproduct? It is there in the question. See, it can be sold for 20 per unit. Na? How many units are there? 2000 units. 2000 into 20. Correct? But on that, you need to incur 8,000 further processing charges, which is processing charges as well as packing charges. Total 10,000. So basically, you will be selling your joint product for 2000 into 20. But in order to sell it at 20 rupees, you need to incur 8,000 plus 2,000. This is further processing cost. So you reduce the further processing cost, and this is your sale value. Then you'll be getting net realizable value from byproduct, which is 30,000. That should be reduced from joint cost. Then you'll be getting net joint cost, which is 3,20,000. Apart from that, there is one more thing, scale of scrap. That also you need to reduce from the joint cost. 5,000 was realized from the sale of scrap, which means what we are trying to say is that some of the joint products might not be good, which is not saleable in its full condition. Then you'll sell it as a scrap. That also we need to reduce. So sale of scrap as well as whatever the sale value that you have got because of selling byproduct, both these things, if you reduce, you'll be getting your net joint cost. Once you get your net joint cost, which is 3,20,000, you need to apportion that to the MP1, MP2 in the ratio of sale value. That's all. MP1, MP2, 5,000 units, 4,000 units. Sale value is given in the question into 60 into 50. Sorry. Here is the sale value, 60 and 50. You multiply with that. You'll be getting your sale value. 3 lakhs and 2 lakhs. What is the ratio? 3:2. In this ratio, you'll be apportioning the net joint cost, which is 3,20,000. You apportion that. 3,20,000 into 3 by 5. 3,20,000 into 2 by 5. Finally, you get joint cost per unit. This is total joint cost. You divide it with number of units, which is 5,000 and 4,000. You'll be getting joint cost per unit. Now, this is cost per unit. Now, let's say you have come to year end. How to value your finished goods? Cost or NRV, whichever is less. Correct? This cost, you compare it with the selling price. Whichever is less, that will be your value. Because your selling price is higher than this cost, therefore your joint products will be valued at cost. Because of the rule, cost or NRV, whichever is less. So therefore, it is valued at cost, which is 38.4 and 32. Closing stock number of units is given in the question. So closing stock number of units into cost per unit will give you value of closing stock of joint products. As simple as that. That's all. Are we done with this? Chalo. So what else we have got? Another one is cost of agricultural produce harvested from biological assets. You know that all these things are covered by Ind AS 41. But once you have got the biological assets, initially they are recognized at FELCTS as per Ind AS 41. Okay. Once they are recognized as FELCTS, this will be taken as the cost, and this is the starting point for Ind AS 2. And that is the ending point for Ind AS 41. So as per Ind AS 41, once you get the harvest, biological harvest, you'll be valuing that at FELCTS. Once you have valued that at FELCTS, which is say for example 1 lakh, now hereafter it becomes inventory and Ind AS 2 will be applied, and this 1 lakh will be taken as cost, which means that FELCTS will be taken as cost of the inventory, and after that Ind AS 2 will apply. This is the only point that you have to keep it in mind. That's all. Next. Another concept is cost formulas. What are all the formulas that you can apply to find out the cost of the inventory? Now, these formulas can be categorized into two categories. One is historical, the other one is non-historical methods. Okay. So what is historical? Very simple. To apply historical methods, first you need to identify whether the items are interchangeable or not. So what do you mean by interchangeable? Interchangeable means, for example, let's say, what raw material example we can? Yeah, wood. Suppose I'm making furniture, Nana. Furniture is my finished good. Let's say wood. This is the raw material. I've bought wooden log. Like that, I've bought 100 wooden logs today. Day before yesterday, I've bought 50 wooden logs. Today, I've bought another 200 wooden logs. All the wooden logs are exactly the same. In that case, if production department comes and says, I need 5 wooden logs, out of this, any wooden log will be given. If any wooden log can be given, then can I say they are ordinarily interchangeable? Yes, because all of them are pretty much the same. That comes under this category. But let's say I've got multiple types of wood, teak wood, rosewood, or mango tree wood, something like that. Then if a production department comes and asks, I need teak wood only should be given. It can't be mixed. In that case, it falls under this category for items that are not ordinarily interchangeable. So before you apply cost formula, first you need to figure out what kind of stock you have got. Are they interchangeable or are they not interchangeable? All of them are of same wood or all of them belong to different wood categories. If they are same wood, then you can apply FIFO method or weighted average method. First in, first out or weighted average method, which you already know. If they are of different wood, then specifically you need to find out their cost. Now, therefore, we call it a specific identification of cost method. So teak wood means what is the cost of it. Specifically, it will be there with you. And that will be the value of the inventory. You understand the point? Mango wood, what is the cost of it? Rosewood, what is the cost of it? Specifically, you need to identify the inventory cost because they are different. If it is ordinarily interchangeable, then farak nahi padta. Whatever the stock that you buy, any stock will be given, and ultimately only on the page you will write those numbers, FIFO method or weighted average method, because all these units can be ordinarily interchangeable. As simple as that. Got it? So when it comes to historical cost method, all you have to do is identify whether the stock is ordinarily interchangeable or not. If it is yes, apply FIFO method or weighted average method. If it is no, then go for specific identification method because each inventory will be unique. Done with this? Okay, if historical method is done and dusted, then we have something called non-historical method. Under that, we have got two methods, standard cost method as well as retailed adjustment selling price method. Now, this is very important, so listen carefully. Sir, what is this standard cost method? I don't know whether you guys remember this in your standard costing lecture in your CA Inter or CMA Inter costing or not. Standard costing can always be applied when there is a consistency in your business where you do repeated stuff again and again at same level of consistency, which means fluctuations must not be there. Customizations must not be there. Must not be there. In that case, standard cost will be suitable. To measure the performance or to control the cost in that particular company, you can apply standard costing. Similarly, here also, when it comes to non-historical methods of measuring your inventory, can I apply standard cost method? Yes, you can, provided in your company, whatever the kind of manufacturing level that is happening, it is more or less consistently the same. Got the point? Clear? That's why here, see, you'll be calculating variances as well. Because you can apply standard costing and standard cost method only you'll apply to find out the value of the inventory. Got it? Clear, Anna? Okay. Now, what about retail or adjusted selling price method? This will be applied mostly by retail agencies, like for example, DMart and all these guys. So what they do is that to calculate the value of the inventory, what they'll do, they'll just buy and sell, na? So they'll see at what price am I selling? Okay, what is my gross margin? From the selling price, you reduce the gross margin, automatically it should become the cost. That's how they value their stock because they'll be getting too much of stock and too much of movement will be there. Every time they can't follow each and every stock. It will be very tiresome work for them. It's practically impossible. So often used in retail trade for measuring what? Inventory of large numbers, focus on this, of rapidly changing items that have very similar margins. Therefore, how will you calculate the value of the inventory? Sales minus gross profit percentage. So, when it comes to non-historical methods, you need to figure out what kind of business you are doing. Is your business standard or is your business is like DMart? If it is standard manufacturing, then you can apply standard cost method. If it is like DMart, where it is a retail center, then you can apply retail or adjusted selling price method to value your inventory. Got it? That is nothing but measurement of techniques of cost only, na? Right? Okay, I can give you an example. Let's go to question number 9. Look at this question number 9. We'll get better idea. Yeah. Question number 9, you'll get better idea. See this. Measurement techniques of cost. Mars Fashions is a new luxury retail company located in Lajpat Nagar, New Delhi. Kindly advise the accountant of the company on the necessary accounting. Okay. One of the company's product lines is beauty products, particularly cosmetics such as lipsticks, moisturizers, compact makeup kits. The company sells hundreds of different brands of these products. Each product is quite similar and is purchased at similar prices and has a short life cycle before a new similar product is introduced. Very, very, very important. Are you guys are getting it? Right. Okay. Next. Uh, and has a short life cycle. Okay. The point of sale and inventory system is not yet fully functioning in this particular department. The sales manager of the cosmetic department is unsure of the cost of each product, but is confident of selling price and has reliably informed you that the gross margin is 65%. Which method will apply? Retail adjusted method. Take the selling price, reduce the gross margin, you'll be getting the cost of your product. That way you can measure the cost. Clear? So here you'll be applying which method, Nana? Which concept that we have learned? Retail adjusted selling price method. Clear? Done? Gross margin 65% means your cost will be what? Say for example, some lipstick selling price is 500. Then the cost will be into 35% because 65% is margin. Na? So 35% will be your cost. So which means 175 will be your cost. That's how you'll do the valuation. Next, look at this. Mars Fashions. Mars Fashions also sells handbags. The company manufactures. So this is retail company. Therefore, we applied that retail adjusted selling price method to find out the cost. This is what manufacturing company. So now let's see what's happening. Mars Fashions also sells handbags. The company manufactures their own handbags as they wish to be assured of the quality and craftsmanship which goes into each handbag. The handbags are manufactured in India in the factory which has made handbags for the last 50 years. So indirectly he's trying to say that they are consistent in what they're doing. Normally, Mars manufactures 1 lakh handbags in a year in their handbag division, which uses 15% of the space and overheads of the head office factory. The division employs 10 people and is seen being an efficient division with the overall company, which means already they have reached their efficiency. In that case, is there a consistency in manufacturing? Yes. Then you will be applying standard cost method. Then you will be applying standard cost method based on normal operating constant. Sorry, normal operating condition. Clear? Done? Okay. That's it. Chalo. Next. Net realizable value, we already know how to calculate. Very simple. You take the estimated selling price, you reduce what? Whatever the cost that you incur to sell. For example, processing and packaging charges, any sales commission, all these things, you just try to what? Reduce it. As simple as it. That will give you NRV. Now remember, many people are getting confused here as well. NRV for finished goods is different. NRV for WIP is different. If you want to calculate NRV for finished goods, it will be selling price minus sales expenses. Sales expenses is nothing but sales commission. That's all. This will be your NRV. But WIP it is different. You'll be having estimated selling price and then you'll be reducing further processing cost. Because WIP is still not finished goods. Now you need to incur further to complete it. Then you reduce selling expenses. That's why here I've highlighted in brackets. But WIP. Okay. So it's very simple to calculate NRV. Got it? Chalo. Next. Okay. Here, there are some 3 important points. Let's try to understand this. Okay. Now, first point. The amount of inventories recognized as an expense in the period will generally be carrying amount of inventory sold in the period in which revenue is recognized and the amount of any write down of inventories to NRV. So, what do you mean by this? Whenever you value your inventory, will you straight away charge it as an expense? No. At the beginning of this Ind AS 2 only, we have seen that it should be treated as an asset. So, it will be treated as an asset. Then once it is sold, on your P&L account, what will happen once it is sold? Sales will be recognized over here. Then automatically cost of sales should be recognized here. In this cost of sales, inventory also will come. So here you're recognizing that as an expense. That's what we have written here. Got the point? Okay. When you are doing this, if there is any write down, you'll do that. We'll see that, okay, in an example. Inventory is used in construction of PP. You're not selling the inventory. You're not selling the finished goods. You're using it in the construction of PP. Sir, what is that, sir? Look at this example. Suppose you have a cement company. What will be your finished good if you are a cement company? Cement. You can directly sell the cement, or if you are constructing a building, you can use your own cement for constructing your own building, right? So first example is where inventory, that is cement, is sold as cement. Got it? Then sales will be recognized on the credit side. Cost of sales, where inventory will be recognized as an expense on the debit side. Of course, with respect to cost or NRV, whichever is less, that also will happen, subject to that rule. But if cement company whose inventory is cement is constructing a building, and for that building, if cements are used, which means you are using inventory for a PP, got the point, which is building, then that carrying amount of inventory will be capitalized to the PP. Then when it will be expensed out in P&L account through depreciation indirectly. Depreciation of what? PP. As simple as that. That's what I've written here. Got it? Chalo, that's it. Look at this example, you'll have an idea. In this example, we'll also cover reversal of write down. Write down means you already know. Cost will be there. If NRV is less than that, you'll be writing down the value of the inventory. Sometimes you will reverse that write down as well. That we'll try to understand with this example. This is the last concept of this particular Ind AS. Let's say cost is 500, NRV is 600. What is the rule? Cost or NRV, whichever is less, is the value of the inventory. So it will be 500. Let's say cost is 500, NRV is 450. Cost or NRV, whichever is less, it is 450. In this case, in the first case, will you do write down? No, because your value of the inventory is 500. NRV is more than that. Therefore, the value should be 500 only. Therefore, there is no question of writing down. But in second case scenario, will you write down? Yes. Because your cost is 500, NRV is 450. Right now, you're showing inventory in your books at 500. Actually, it should be shown at 450. Therefore, you'll reduce the value by 50. So, write down it by 50. Where the entry will be to inventory, because asset has to be reduced. Therefore, you will credit by 50. You will be taking that loss to P&L account. So, P&L account debit to inventory. Clear? Okay. Now, what are we discussing? Reversal of write down. When you will do the reversal? Very simple. Next year, your carrying amount is 450. Why? From 500, you have already got it down to 450 by reducing the value of the inventory by 50. So now inventory will be shown at 450, correct? However, let's say NRV is 600. Oh my God, sir, in that case, I'll increase the entire 150 value. No, 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 no. How much did you reduce already? Sir, I've written it down by 50. To that much only you can reverse. Which means I can increase the value of the inventory by only 50, which I have already reduced earlier. Yes, that is the ceiling limit. Okay. So therefore, inventory debit, because you have to increase the value to P&L account. Now the revised amount of the inventory will be 500. Pretty simple. Clear? This revenue recognition concept already I've explained. So which means when it comes to reversal of write down, you can reverse it only to the extent of earlier write down. Suppose here, if NRV is 475, then you can increase it only to the extent of 25. That too you can do this only if you have already done the write down. Suppose if you don't write down, suppose the write down did not happen and normal cost of the inventory is 450 and NRV is 600, whichever is less, then 450 will be the value. Reversal of write down will happen. First of all, to reverse the write down should have happened in the first place. To do reversal of write down should have happened in the first place. Because write down did happen in the first place, now I'll be thinking about reversal. And that too, when I'm doing reversal, it will be maxed out to the extent of the write down that you have done already. Even though here there is 150 increase in value, but ultimately I'll be increasing that only by 50, because to the extent of 50 only I've reduced the value. So you cannot go beyond the cost. That is the logic. Clear? That's it, guys. So with this, we are done with this revision session. I've covered all the important points and important sums as well, whatever that is necessary to understand the concepts. Now, if you guys have really loved this video and the explanation, please comment. I'll be very happy to see. And also, if you want any other specific Ind AS or any problems in any specific Ind AS or any specific Ind AS where you want me to cover all the important problems, that also you please comment, or whatever that you feel, you comment. If you have any doubts, you comment. My job is to watch each and every comment. And of course, if there are likes, I'll be very happy personally. And then I'll try to clear it off. Got it? If you have any big doubt, you can WhatsApp to this number. I will literally clear your doubts through audio message. Trust me, I do that. Got the point? Yes? Chalo, fantastic. Hope you have loved the video, and stick to the channel, subscribe to the channel, because a lot more videos are going to come. Next, it will be mostly Ind AS 36 and followed by Ind AS 12, 103, 110, all these things also are going to come, including 116. Clear? And some of them are asking 101 as well. That also I'll try to do. Got it? Chalo. Bye guys.